If you're a new trader and you're looking to master and completely understand candlestick charts and candlestick patterns, then look no further than this video. This is the ultimate beginner's guide to understanding and mastering candlestick charts and candlestick patterns. In this video, you're going to learn about the history of Japanese candlesticks. You're also going to learn why candlesticks are so important in technical analysis. You're also going to learn about the anatomy of what makes up a candlestick. Then I'm going to show you the 5 most powerful candlestick patterns in existence. And then I'm going to show you an easy trading strategy that you can take to the markets using candlestick patterns. So some quick history on how candlesticks actually came to be. This is actually a Japanese strategy and philosophy that came about early as like 1654, they say, when rice trading first started becoming popular in Japan. Now, a gentleman by the name of Munehisa Homa, also known as Sokya Honma, hopefully I'm pronouncing those correctly, is given credit to Japanese candlesticks. And the reason why he created Japanese candlesticks is because he knew that the markets were driven by emotions, and he wanted a way more sophisticated than just a regular bar chart to be able to track what's happening with humans' emotions. Now, Japanese candlesticks are widespread across the Western world, and pretty much everyone uses them because there's significant advantages to reading Japanese candlesticks versus just reading a line chart or a bar chart. Now that you understand the history of Japanese candlesticks, let me explain to you why it's so important when using candlesticks in your technical analysis. Number one, candlesticks sort of work as a visual representation of what is actually happening in the market. And it gives us an idea of what's happening with the open of a session, the close of a session, as well as the high and low of a session, which other sort of charts don't allow us to see. The beautiful thing about Japanese candlesticks is they can be flexible. You can use them alone, or you can use them in conjunction with other technical indicators or things like support and resistance. And really the main advantage to Japanese candlesticks is that it helps us understand fear, greed, and hope, these human emotions, and how buyers and sellers are interacting with one another in the market. So enough about that. Let's actually get in and talk about the anatomy of what makes up a Japanese candlestick. Just like how a real human body is made up of, arms and legs and body and torso and all this stuff, a Japanese candlestick also has its own anatomy. So here you can see both a bullish candle here in white as well as a bearish candle here in black. And let me explain what this actually means. So you'll notice that the open is here at this bottom of this body. So the candlestick is really made up of 2 parts. We have the body, also referred to as the real body, and then we have these upper and lower shadows. These are also referred to as wicks. I think most commonly they're referred to as wicks and a body. Okay. Now, what these signify is the body signifies the open and the close. And each candle represents a certain time period. So let's just say, for example, we're looking at the hour chart. That means that this candle here represents 1 hour in time, and we can get a good idea of how buyers and sellers interacted during this time. So when the hour opened up, let's say it was 5 o'clock, the hour opened up here. This was the price when the session opened. This was the price when the session closed at 6 o'clock. Okay. Now, we also have these wicks, which means that during this session or during this hour-long period, price went as low as the bottom of this wick, and price ultimately went as high as the upper part of this wick or this upper shadow, but ultimately price ended up closing right here. Now, in this scenario, we're looking at white and black candles. A lot of the times you'll also see green and red candles. It's just personal preference. In this document that I have pulled up, it's white and black. But the white candles happen to be bullish candlesticks. You may also see that as green. These are bullish candlesticks, meaning that price is moving upwards. Now, also on the other hand, we have bearish candlesticks, which are represented by typically black or by red. And all that means is it means that the open of this session, meaning if we're on the hourly time frame, again, it opened right here. At the end of the session, it closed right here. This was the price at the close of the hour. It went as low as this point here, and it went as high as this point here. So this is the anatomy of a Japanese candlestick. It's made up of the body and these wicks, or sometimes called shadows. Now that you've got an idea of the anatomy of a candlestick, let's go ahead and take a look at the most powerful candlestick pattern. The number one, probably most common, is a engulfing candlestick or an engulfing bar. And we generally see a bearish and a bullish engulfing bar. Now, let me explain the psychology behind how this works. How it's going to look in a bearish scenario is we're going to have a bullish candle here in white, and then we're going to have a big bearish engulfing candle. Now, what does this mean? This means that this candle completely engulfs this candle. As you can see, that this white candle here is relatively small in comparison to this big black candle that is heading in the bearish direction. As you can see, price opened here and it closed here, and this candle completely engulfed the previous candle. Now, you'll also know here people talk about the range of a candle. The range of the candle is just the high all the way to the low. So in this case, this would be the high, this would be the low. That's the range of the candle. So this is a powerful signal that says that, hey, the market may have been turning upwards, but now we have this really strong momentum from the bears that's engulfing this entire candlestick range, and price is likely to head on down. So to see that play out in action, generally we see this at the top of reversals or at the reversal in a trend, but you can see here we had this small white body and completely engulfed by this bearish engulfing bar, and as you can see, the market knocked down. Now, on the opposite end, we also have bullish engulfing bars. That means that we have a down candle followed by a really strong up candle. So it's just the opposite, but the characteristics are the same. This large candle completely engulfs the previous candle. So if you want to see how it plays out here, you can see that there was this black candle here completely engulfed by this white candle, and then price started to move up. Now, granted, this is a powerful candlestick chart pattern, but candlestick chart patterns alone sometimes aren't enough. So you may need to combine this with other stuff, which we'll talk about in just a second. The next common candlestick pattern is called a doji. And a doji is a lot of times an indecision candle. And as you can see, characteristic of doji candles, generally they have these really small bodies, right? Where the opening and the closing price is almost the exact same thing. So what does that mean? The bears and the bulls, or the buyers and the sellers, were in a fight to move up and move down, and they basically ended that hour-long session, for example, right at the same place, right? That could be a minute-long session, 5-minute long, a day session. It doesn't matter, right? But the idea here, in this time period, buyers and sellers were fighting, and they opened and closed at relatively the same price. Now you can see that with these wicks, that price went as high as here during the session and went as low as here in the session, but price ultimately closed relatively close to where the opening price originally was. So a lot of the times these doji candlestick patterns are known as indecision candles, where the market can't make up its mind. So sometimes these can lead to reversals in the market, where you may see this at the top of a trend and then you see the market starting to come back down. Now, there's two types of doji candlestick pattern, just like we had two types of engulfing candles. There's a dragonfly candle, which is a bullish candlestick, which essentially, again, it just has this really small sort of body. It kind of looks like a dragonfly with its, wings or tail, right? And it had this long tail down here, but the opening closing price were relatively the exact same during the session. And this is generally a bullish candlestick price action, because we see that the sellers are trying to force the price down, and ultimately the buyers come back and they win, and they force the price up to right around where the opening price was. So you can see an example of this playing out. We had this really small body with this really long wick, and basically sellers tried to go down here and ultimately they couldn't, and price starts to move back upwards. Now we also have something that's a bearish candlestick called a gravestone doji. And if you look at this, then you can see that buyers tried to force the price higher, but ultimately sellers stepped in and brought the price back down right towards where the opening price was. So again, doji, small body, a long wick. This is a bearish candlestick pattern. So we can see this here. We saw kind of at the top of this trend, we saw that the buyers tried to push price even higher. Sellers stepped in that session. The price ended up right here, and then the price started knocking down. The next pattern is a morning star. We have a morning star and an evening star. A morning star is a bullish catalyst, and a evening star is a bearish catalyst, and essentially it's made up of 3 candles. So generally we have this black bearish candle here, followed by another bearish candle here. Well, it could be bullish or bearish, but generally it's a smaller candle. And then we have a really large bullish candle that comes and kind of engulfs these 2 previous candles, which shows us a sign that, we had sellers strong in the market, and then sellers become less strong, and then we had a wave of buyers come in. And basically this is showing that this could be a reversal pattern and that buyers may take over. Again, you can see this kind of pull out here. We had this strong bearish candle, and then we had this kind of indecision or this small bullish candle. Then we had this really large bullish candle, which I guess technically it doesn't need to entirely engulf the previous bearish candle here, but it's better if it does. But if it has this strong sign of momentum, then you can see how the market continued upwards. Now, on the other hand, we also have an evening star candlestick pattern, which is essentially just the opposite, right? We have this white bullish candle, we have a small candle, and then we have a bearish candle, saying that this is a market direction. This is a change in buyers and sellers. So let's see how this plays out. So you can see right here, we had this strong white candle, and then we had this sort of smaller candle that happens, and then we had this really strong looking black bearish candle, and then we see the market knocked down. The next candlestick pattern that we have is a pin bar. There's 2 variations of a pin bar. There's a hammer and there's a shooting star. So as you can see, this is a hammer. It's got kind of this small little body here at the top, and then it's got this long lower shadow or long lower wick. So it kind of looks like a hammer, right? And generally, this is a sign of a reversal as well. We see that sellers tried to push the price all the way down to here, but buyers came back in, and they actually ended up closing the session above where the open price was, showing that the buyers are in control. Now, on the other end, we also have the shooting star, which is essentially a pin bar, but in the bearish direction. So the difference here with this is that we have this long upper wick or long upper shadow, and then we have the closing price closing in the downward direction. So you can see that here, buyers tried to push price up here. Sellers ultimately won the session and closed below where the opening price of the session was, and the market knocks down. The last candlestick chart pattern that we'll look at is tweezers. There's tweezer bottoms and there is tweezer tops. And essentially what it looks like is it looks like a pair of tweezers. Generally, tweezers have kind of similar bodies and wicks, and you can see what it looks like right here. We had a bearish candle, then a bullish candle. And for a tweezer top, we had a bullish candle and then we had a bearish candle. So here you can see the example of a tweezer bottom. You can see these 2 candlesticks that look like kind of like tweezers. They have similar sized bodies and wicks. And generally this is the sign that we've hit a bottom. Okay, now what we're gonna do is we're going to get in and actually talk about a trading strategy that actually works that you can use using candlestick patterns. But before we do, if this video is helpful, then you'll find this extremely helpful. If you'd like to trade with a 10-time funded professional prop trader in the morning so you can shortcut the learning curve, then go on over to fundedtraderfasttrack.com. Now, I know you're probably wondering, okay, this is great, but how do we put this all into conjunction and make a trading strategy using these candlestick patterns? And if you're asking yourself that question, then I made a really simple video here that explains a really powerful trading strategy that works in almost any market, whether it's Forex or stock trading or you're trading crypto. It works in almost any market. It's been proven for a long period of time, and it uses 2 really simple free indicators and 1 really powerful candlestick pattern. Go ahead and check out that video right now.